We say in our statement of longer-run goals and monetary policy strategy that the committee would be concerned if inflation were running persistently above or below 2%. So persistent carries the sense of something that's not transient, something that will sustain over a period of time. And in this case, as we look at these readings in the first quarter for core, we do see good reasons to think that some or all of the unexpected decrease may wind up being transient. And I point to things like portfolio management, service prices, apparel prices, and other things. In addition, the trimmed mean measures of inflation did not go down as much. Indeed, Dallas trim mean is at 2%. But to go back to your question, if we did see a persistent inflation running persistently below, then that is something the committee would be concerned about and something that we would take into account in setting policy.
Sam.
Thanks very much. Sam Fleming for the Financial Times. Let me carry on the same theme. There's obviously been a lot of speculation in the markets about the prospects for a rate reduction this year. Do you think markets have effectively got ahead of themselves on this? And what sort of economic conditions would you need to see to give serious consideration of a rate cut? In discussion, for example, about the 1995 example, do you actually need to see a looming recession to cut rates, or could an insurance cut be appropriate?
So, as I mentioned, we've just come through a two-day meeting, and we've done a deep dive on economic and financial conditions in the United States and around the world, and thought about our policy. And we do think our policy stance is appropriate right now. We don't see a strong case for moving in either direction. So, we do, of course, though, as a routine matter, as you will know, we look not only at our baseline, but we also look at alternative simulations, both better and worse, and we ask ourselves what the appropriate policy response would be. But that's all we do, and I would just say that we're comfortable. The committee is comfortable with our current policy stance.
Hi, Howard Schneider with Reuters. Shifting gears a little bit, I wondered if you could flesh out, I know you're describing it as a small technical adjustment, but on the IOER federal funds spread, give us a sense of why it matters whether or not this breaches the upper limit a little bit. Is there any feed through to broader credit conditions and financial conditions that you worry about, or is it simply a matter of the Fed showing that it can control what it says it's controlling? And I do have a follow-up.
A small temporary deviation outside of the range would really carry wouldn't be important, as your question suggests. But we do think it's important that we be able to, control the federal funds rate and generally keep it within the range. That's just good monetary policy, good monetary control. So, we think it's important, and we have the tools to do that. So we've used them again today. And again, this is just a technical fix. It really has no implications for policy.
But as a follow-up on this, it is demonstrating that you control the market you want to control. And I guess the question is, at what point would these steady declines in the IOER, in steady widening of this spread, if it continues, essentially become the policy choice?
Yeah, so generally speaking, the federal funds rate, we control only directly the federal funds rate in terms of the market rate. And the transmission of the federal funds rate into other short-term rates, money market rates, has been very good over a long period of time. And that's important because it's really broader financial conditions that matter, not so much precisely the federal funds rate. So I think the Fed controlling the federal funds rate is actually important from that standpoint. And I don't see us not controlling it. So I think we'll continue to control it, and it will continue to transmit well into broader financial conditions.
Michael McKee with Bloomberg. I'm curious about the financial conditions that you see out there. The minutes in the March meeting tell us a few officials worried about financial stability risks. Was there a broader discussion at this meeting? Any consensus on whether such risks are growing as the markets hit new highs and we do see some instability in short-end trading? Is it possible that rates are too low at this point?
So we actually have a financial stability briefing and opportunity for comment every other meeting. So we had our quarterly briefing yesterday, as a matter of fact, and had that discussion as well. And I think there haven't been a lot of changes since the last meeting, but I'll just go through the way we think about it. First, we've developed and published our framework for assessing financial stability vulnerabilities, put it out for comment, and welcome any feedback that we get from the public. And that enables us to focus our assessments, regularly on the same thing so that we can be held